So good morning, everybody, and thank you to all those who are joining us for this third webcast in our series. Today's webcast will cover the latest developments in UK tax. My name is Alex Singer, a Managing Director in the International Tax Practice in EY Israel, and I'm your moderator for today's webcast. Our presenters in the UK are Lawrence Hall, who's a corporate tax partner in the UK office with many years of experience supporting clients across a whole range of UK and international tax issues. Irina Scullion is a senior manager in our indirect tax team and has many years of experience across pan-European VAT and indirect taxes. Rachel Chalmers is a senior manager in EY UK's People Advisory Services team, specializing in board and employment tax matters. Thank you for joining us today. We have quite an ambitious agenda to cover over the next 50 minutes or so. We'll be covering the key UK tax issues you should be considering in relation to Brexit, as well as employee-related aspects. Lawrence will then provide a brief summary of the key measures announced in the UK budget last week and key tax issues related to sales into the UK, IP, and supply chain. We'll also have a short session on employment-related matters, including stock-based compensation and the new off-payroll working rules that could impose withholding tax obligations on payments to contractors. The UK effectively left the European Union on 31st of December 2020. This followed a number of years of significant uncertainty about what the implications would be from both a trade perspective and a tax perspective. So we are now a little over 2 months in, and I would like to ask the presenters, starting with Irina, to discuss some of the key tax aspects that their clients are tackling as a result of Brexit.
Good morning. Hope you're all well. I just wanted to run through the VAT and customs key takeaways from Brexit. Although I note that at root, this is a large change in law. As a starting point, VAT and customs in the UK has always been governed by EU directive, which is to say that all of the member states formerly had a somewhat harmonised system of tax, which is no longer necessarily the case. There's still a fair amount of uncertainty that's happening with regards to the legal framework and which court cases that may have taken place, say in Poland, will be still for the UK. So that's one of the main points I'd like to make. But if we just run through, for goods, so physical, tangible goods, it is clear that the United Kingdom is not the United Kingdom. Indeed, it is Great Britain, which is Wales, England, and Scotland, being treated as one area, and then Northern Ireland, on the island of Ireland, still being treated as a quasi part of the European Union for goods. It is very important that, to the extent you or your subsidiaries have any Northern Irish business, that you take advice with regards to that, as it remains very, very complex. For services, the United Kingdom is the United Kingdom. So for all four of the individual countries together, there hasn't been a large amount of change thus far in terms of law of how these services are governed. However, we are expecting that there will be complications. So, for example, the mini one-stop shop scheme will no longer be applicable from the UK for Europe. Otherwise, it's important to note that going forward, the United Kingdom forms its own customs remit, which means that any movements of goods into and out of will be treated as imports and exports, as opposed to acquisitions and dispatches. That will result potentially in hold-ups, as you may have seen on our news, over the course of the coming weeks. Otherwise, UK VAT registration numbers will no longer be able to be validated by the EU system. Alex, if you could move on to the next slide, that would be great. Thank you. I also wanted to go through the key actions that we view will be relevant to most of our clients. And I would say that this is a general approach as opposed to a specific. For each business, your position has the potential to be rather different. And so we would encourage you to reach out if there's any areas that you're uncertain on. It will be important to communicate with priority customers and suppliers on any expected Brexit impacts that your business may have. So that may be to do with the supply chain and goods potentially being held up. Say, if you've been using the Netherlands as a distribution centre for Europe, that may have to change, either because of hold-ups getting the goods into Europe and back out, or otherwise wanting to change your supply chain to go straight to the UK. For services, it will be important to understand the Brexit impacts in terms of potential use and enjoyment implications. So, for example, a lot of software companies will have developers in Eastern Europe, say in Poland or in Hungary. It will be very, very important to understand the place of supply to ensure that VAT is charged on a correct basis, particularly on an intercompany basis. Apply for all of the relevant EORI numbers and VAT registrations in both Great Britain, so Scotland, England and Wales, and Northern Ireland, because potentially one business could have two VAT registration numbers within the UK because of the interaction of the Good Friday Agreement and the exit of the United Kingdom from the Union. We'd also advise you to closely monitor the impact of Brexit on your cost base. So, for example, the goods potential hold-ups that I've alluded to may result in further cost, and it will be important, we feel, for our clients to understand whether that should be passed on to customers, whether it is a margin hit potentially to your own business, or whether there is some form of changing or tweaking your model to ensure that those cost base don't become material to you. Aside from the VAT impact of the movement of goods and the customs, there are much, much larger implications to consider. So, for example, the regulatory requirements of moving goods around, for example, a CE certification, which says around the safety of goods. And then finally, whilst not necessarily Brexit related, the UK is going into making tax digital, and they're starting with VAT. Making tax digital is effectively a way for our tax authority, Her Majesty's Revenue and Customs, to be able to have a look at entities' tax returns on an online basis, on a digital basis, and they're starting with VAT. This takes full effect in April 2021, so in 2 months' time, and it has been put back a year because of COVID-19. We would encourage that, given the delays to this taking place, and also the potential complication now that may happen in terms of Brexit and further systems requirements, that this is looked at as soon as possible. Otherwise, I'm just going to very, very, very quickly touch on the budget now. We'll cover it more in greater detail a bit later. There wasn't that much for indirect tax this time, except to say that our reduced rate for hospitality has been extended for a further 6 months until the 30th of April, at which point we will go to a blended rate of 12.5% to help those businesses for a bit longer. If any of you have any questions at the end, I'd be very, very happy to take them. Thank you for your time.
Thanks, Irina. I'll just touch on the people aspects of Brexit and give you an overview of that. So just to set the scene, the UK was introducing a new immigration system regardless of Brexit. So there have been changes to how the UK government views and monitors rights to work in the UK and gives permission for non-UK individuals to work in the UK. Brexit has added a further consideration for businesses who have workers either working in the UK or travelling in to work in the UK or travelling from the UK to work in Europe. As you may know, prior to Brexit, we had freedom of movement within the EU, so between the UK and other EU members, and also freedom to work. Post-Brexit, this has stopped. So non-UK EU nationals will now need permissions to work in the UK as if they were individuals from non-EU countries prior to Brexit. This has introduced more complexity for businesses to consider and costs of visa, etc., that they wouldn't have had to consider for EU nationals working in the UK previously. So we would encourage that any businesses that have a footprint in the UK, so have workers in the UK or those travelling between the UK and Europe, to map these out and consider where they're identifying the correct rights to work and the visa requirements around that. Employers would typically need to have a sponsorship licence granted by the UK authorities to employ non-UK nationals. This has cost and compliance requirements attached to it as well, obviously. Further aspects for employers to consider post-Brexit is social security. So very broadly speaking, previously individuals could move between European countries and remain within their home social security system, so pay their own social security and secure their state benefits in their home country for a period of time. Post-Brexit, this no longer applies between UK and European countries. Therefore, consideration would need to be given on a case-by-case basis. There have been some agreements that would allow an extension of this and allow you to remain in your home social security system, but that doesn't apply in all circumstances. So we would encourage employers where, again, you've got employees moving between Europe and the UK to consider the social security requirements and the costs associated with that. Income tax has been a little less complex to deal with post-Brexit, as countries would have their own double tax agreements on a country-by-country basis rather than with the European Union, but social security being a European handled tax has had that impact, and now consideration needs to be given on agreements between countries. Aside from Brexit, this last year has brought a whole load of new challenges and opportunities to employers with international remote working. But perhaps most immediately, when the COVID pandemic hit, we're working with a lot of businesses who had employees stranded overseas, as it were, to consider what their employer obligations and associated costs might be with individuals stuck overseas, essentially. As travel restrictions have changed and in some cases relaxed over the last year, we're still seeing businesses now grappling perhaps in a more strategic way with international remote working. So workers that have realised perhaps that their role can be done remotely and internationally, and maybe they don't want to be sitting in a UK office but want to be working somewhere a lot sunnier, for example, and making requests of their employers to work this way. This brings a whole lot of complexity around, for example, right to working visas, as well as tax and social security costs, and employers triggering, for example, PE risks or payroll or pension obligations in countries that they might not even have a presence themselves, but now have workers working in remotely. So businesses we're working with, it depends very much on the sector and the size and their appetite. Some of them are rolling out strategies that would allow employees to work in this way, or in fact encouraging it, realising that this opens up their talent pool beyond the immediate home location. But it is a complex area, so we've been working with lots of businesses on that. And if you've got any questions on that, we'd encourage you to reach out. But that's just an overview of the people aspects, and I'll be returning later in the session to go in a few more details, and I'll hand over to Lawrence now.
Thanks, Rachel. I think it's probably fair to say that the direct corporate tax impact of Brexit is not necessarily that profound, except within certain regulated industries, and I'll come on to that on the next slide. As with VAT, as already been said, the UK is no longer bound by the accumulated body of EU law. But that doesn't mean that EU precedent will not continue to apply in a UK context. That somewhat complex judicial jurisprudence issue is being worked through. And in particular, some taxpayers may be interested in the impact on EU state aid and how that's going to play out. And the answer is today, we don't know. We expect that some EU law will continue to apply where it's consistent with the UK jurisprudence, but others may be changed either immediately or over time. It's also important to state that none of the UK's bilateral tax treaties are impacted by Brexit. Some have equivalence provisions in them, but where that is the case, Either protocols have already been agreed or are being negotiated, and we wouldn't expect EU equivalents to have any significant impact on the application of UK double tax treaties. There are certain impacts that have been immediately felt for those of us who've been working on DAX 6 and MDR reporting. That was particularly profound when we came back from the holidays to discover that the entire regime had changed overnight, and we now only have to report based on D hallmarks rather than the whole range of DAX 6 reporting. There is also a formal end to the requirement for exchange of information. However, I would expect that to be agreed between the UK and the EU going forward, as both sides are keen that the exchange of information continues. There are some impacts as we move away from the interest and royalties and parent subsidiary directive into the application of bilateral double tax treaties on both inbound and outbound withholding taxes. In particular, a number of the EU member states can't get to 0% withholding on dividends when they're paid to a UK holding company. Some countries, notably Italy, have taken unilateral measures to correct this and preserve the benefit effectively of the parent subsidiary directive. Others are going to wait for bilateral treaties to be renegotiated. And probably the one we've seen most often is UK companies with German subsidiaries, where the rate of dividend withholding tax is 5%, are needing to do some restructuring so that profits can be repatriated using capital redemptions rather than dividends. Because the UK has dividend participation exemption, any withholding tax that would be suffered on dividends is effectively a wasted tax. On outbound payments from the UK, the UK doesn't impose withholding tax on outbound dividends, but there is a requirement to withhold on certain royalties and also on interest payments. Again, this is very often overruled by bilateral treaties, and there are also some domestic exemptions that can be taken advantage of to eliminate withholding tax on interest payments. Should move on to the next slide, Alex. As I said, the effect of Brexit on direct tax operating models has probably been relatively limited to those groups who are directly impacted by regulated matters rather than by tax matters. This is particularly true in sectors such as health, media, and financial services, where the requirement to operate under an EU regulated model has dictated some change to the structure and operating model within groups. What we've seen typically is, rather than transfer a whole of a business, groups have started to operate dual hub models or EU countries with UK branches. The regulators throughout the EU so far have tended to take a relatively light touch approach on making these models work, and we expect that to continue into the future. Although, since financial services was not part of the comprehensive trade deal that was signed between the EU and the UK, there may be some tension to come on the area of passporting and financial services provision. What we have seen, and my last point on this before we move on, is that regulatory requirements are pretty closely aligned with transfer pricing and DEMPI principles. So, as a general rule, if you are aligning your supply chain with your DEMPI functions, typically the regulatory issues associated with Brexit will be manageable.
So thank you, Lawrence, for that, and for the other panelists as well. The UK is considered as a favourable European hub, both as a holding company location as well as a gateway to Europe for supply chain and distribution activities. In the next section, Lawrence will be discussing key tax issues related to UK sales and IP, looking at focus areas such as permanent establishment and transfer pricing, digital services tax, as well as opportunities for IP regimes and favorable R&D credits. Starting with a summary of the key measures announced in the UK budget last week, and showing us how the UK remains an attractive holding company, financing, and distribution location.
Thanks, Alex. Probably worth giving a little bit of background on the UK budget. Firstly, it was predominantly, I think, correctly described as a COVID budget. There is expected to be a second budget later in the year, probably October or November, which is likely to be a much more substantive tax technical budget. And in particular, a number of consultations were launched or are about to be launched, and we wouldn't expect the effect of those to come through until that technical budget in the fall. What was announced and probably gained most of the headlines in the corporate tax world is a deferred increase in the headline corporation tax rate to 25%, which is deferred effective on 1st of April 2023. But for those of you who report under US GAAP or IFRS, we do expect these measures to be passed and become substantially enacted sometime in the summer, probably June or July. So although the actual increase in the rate won't take effect until 2023, it might have an impact on your financial statements, such as your deferred tax assets or liabilities. We did see a slight relaxation in the loss carryback rules, up to a limit of 2 million of losses per group. There is now provision to carry back not just 1 year as previously, but up to 3 years. The other headline grabbing measure was related to the so-called super deduction, to try and encourage companies to immediately invest in capital and infrastructure. There is going to be a deduction of up to 130% of qualifying capital costs, which can be taken as a current year deduction. Another measure that was announced that had been trailed somewhat off the back of Brexit was the creation of a so-called free ports. While we don't have the full details of how these will operate, certain measures are going to be introduced to stimulate investment in these economic areas, including enhanced capital allowances, some relief from stamp duty, and also around business rates and employers' social security contributions. I think it's worth mentioning things that didn't happen in the budget. There was no real substantial change in the UK's participation exemption, nor had been somewhat trailed. Was there any change announced in respect of UK interest deduction rules? So the UK still has a pretty substantial comprehensive participation exemption as a holding company regime, and is still one of the few territories that will still allow both connected and third-party debt and interest relief. Alex, should we move on? So as Alex said, we're going to briefly touch on some supply chain and IP considerations. And one thing that very regularly crops up in conversations with clients is the UK's attitude to permanent establishments. And I think this is particularly true since the BEPS project and the shift in focus to the idea that it is people that create value rather than contractual relationships within organizations. Over the last 2 or 3 years, we've certainly seen an increase in tax authority scrutiny of relationships that could give rise to a PE. While the UK definition is closely linked to the OECD Model Convention, I think the particular focus from the UK authorities is around structures which either result in UK sales being negotiated here or substantially negotiated. And I've listed out a few of the kind of structures that have come under increasing scrutiny, including dependent agents, cost plus sales and marketing activities, and also commissionaire structures, all of which have attracted increased scrutiny in recent years. I think the good news is that the tax authorities have shown a general willingness to use transfer pricing as an appropriate method to deal with permanent establishment issues. The UK tax authorities are not overly concerned with the form of assessing overseas companies through PEs. They're more interested in capturing the right amount of profit, and therefore there is, I think, a degree of pragmatism around settling these issues based on transfer pricing. I think the other thing, as well as sales-based activities, that we've seen an uptick in activity is also around what I would call high-value R&D functions. Again, closely aligned with the OECD BEPS project, the focus is now on whether R&D is truly routine and therefore is appropriately rewarded through a typical cost-plus arrangement, where supervisory functions or original invention or creativity is being carried on in the UK. The tax authorities are much more likely to either look for a greater reward for the UK, or in extreme cases, have even sought to contend that the IP that's being developed should be owned by the UK company rather than transferred contractually to the person who is paying for it under a traditional R&D cost plus arrangement. Next slide, Alex. I think closely aligned with questions of permanent establishments, many of you will also, who have invested in the UK, be familiar with the introduction of our Diverted Profits Tax. This is a wholly new tax that sits outside of traditional corporation tax that was introduced effective in April 2015. Upon its introduction, I think it's fair to say that there was a first wave of tax authority activity that was largely focused around some very large multinational taxpayers, where the perception internationally and domestically in the UK was that profits were being diverted through arrangements that could be considered to be artificial. As those cases have typically been settled, the attention of the tax authorities has now moved on to more, smaller and more routine taxpayers. But it's still worth noting that diverted profits tax is a tax that does require the initiative of the tax authorities. It's not part of our self-assessment, and the onus is on HMRC as the taxing authority to establish that there has been a qualifying diversion of profits, and consequently they do need to raise a specific charging notice in order to assess diverted profits tax. There are two broad potential applications that groups need to be aware of. The first is, as well as looking for actual permanent establishments, if the tax authorities consider that steps have been taken to artificially avoid a permanent establishment in the UK, where substantial UK sales are being made, then there is an opportunity for them to raise diverted profits tax to recover tax that would not be otherwise recoverable on a traditional permanent establishment. The second range of diverted profits tax activity concerns essentially shifting profit between the UK and what have traditionally been seen as low tax and low substance entities. So where it's not sufficient for the tax authorities to establish that there is a low tax entity where profit is being shifted to, but they must also establish that the low tax entity does not have sufficient substance commensurate with the profit it's earning. So this really, again, is aligned to the OECD BEPS project and seeking to align profit generation with people functions, and where the tax authorities consider that there are disproportionately large amount of people functions in the UK relative to the amount of profit being earned, they may seek to apply DPT. One important thing to note, sorry, just to finish up on DPT, is that if a DPT charging notice is raised, it can be displaced by means of a transfer pricing adjustment agreed between the taxpayer and the tax authorities within 18 months. So there is this period where the super tax, currently at 25%, which will go up to 31% from 2023, can be brought back into the realm of usual corporation tax by means of agreeing a transfer pricing adjustment. Thanks, Alex. Just moving on now, I want to talk very briefly about the UK regime for intangible fixed assets, IP and goodwill. I think the UK, it's fair to say, has one of the most generous regimes allowing for the amortization of intangibles. And in particular, it is a feature of the UK system that where the UK acquires intangibles from a related party, that transaction is always deemed to take place at market value. So particularly for incubator, startup and market penetration transactions, where the UK might be seen as a favorable location to establish a hub, the UK can acquire IP from a related party and achieve a step up, which will then be amortized, typically for most IP in accordance with the GAAP, so over its useful life. And then for goodwill and customer-related intangibles, there's a specific regime allowing for amortization over 15 years, an effective 6.5% per annum relief. There are some specific rules relating to goodwill and customer-related intangibles. These need to be bundled as part of an acquisition with other qualifying IP in accordance with a ratio. But in general, I think if transactions are carefully planned, both identifiable IP, goodwill, and customer-related intangibles should become qualifying assets at fair market value when they're brought into the UK. Touching also briefly on two specific regimes that will be of interest to companies that have high value intangibles and are carrying out research and development. The first is our research and development credits. These are aimed at boosting specific research into scientific and technological innovation. There is a need for the cost, the focus to actually, work on something which is considered to be hard to overcome, inverted commas, and that will need to be documented, both the problem that had been solving and also the method of capturing the expenses need to be documented, captured, and HMRC will look at that methodology. The good news, though, is that the credit is actually in the form of a subvention. You can turn your credit into cash. That's treated effectively as an above-the-line subsidy payment by the government. And typically what will happen if you have a claim is that it will be paid, you'll get the cash, and then subsequent to receiving the cash, you'll, the tax authorities will examine the validity of the claim. So there can be a very positive cash flow benefit from that. Shall we move on, Alex? And then also wanted to briefly touch on Patent Box, which, given the increase in the headline rate of corporation tax, may be become even more important for those companies that have truly innovative and registered protected IP. Effectively, it provides a deduction that gives an effective 10% tax rate in the UK. So there is a huge difference between the headline rate and the rate on qualifying profits. Currently, it only applies to UK or European patents, although a consultation exercise has been announced in the budget that might extend that further. Likewise, that consultation is also looking at whether the research and development tax credit regime might be made more generous to attract more innovation into the UK. If there are UK or European patents, and those UK or European patents form part of either product sales or services income, then effectively that profit and associated costs can be brought into the special regime, resulting in the 10% effective rate of tax. 2 points to note, though. It is important that the UK company is actively involved in managing the IP. It can't just be a passive flow-through entity. It must, again, align to the BEPS project, which I've mentioned several times already. There does need to be substance in the UK involved in the management and exploitation of the IP. And secondly, again, in order to be OECD compliant, there does need to be an alignment of R&D cost and expense within the UK patent box company and the overall group. This is the so-called nexus fraction. But when we're looking at supply chains, one important feature of the UK patent box regime, which perhaps differs from other innovation boxes, is that that is looked at on an entity basis, not geographical basis. So it is still possible to have a UK patent box qualifying company, even if the R&D is being carried on outside of the UK. And then very briefly, I just wanted to finally touch on the digital services tax, which the UK, I think, along with some other countries, has sort of unilaterally introduced in the UK case from April 2020. This at the moment is a pretty limited tax. It is aimed at specific digital business models, very specifically internet search engines, social media services, and certain online marketplaces. It's also important to note that there is a threshold. If the group's worldwide digital turnover doesn't exceed 500 million and the UK revenue doesn't exceed 25 million, then companies, groups are not caught by the UK DST. And also that the first 25 million of UK digital services turnover in any event is always tax-free. The tax is basically assessed at a 2% rate. This gives an allowable deduction against corporation tax, but is not a credit, it is a deduction. The final point I just want to make on digital services tax is that the UK does see this as a temporary measure. As an active participant in the OECD, the UK is far more interested in developing multilateral approaches to taxing digital enterprises. And in particular, the UK has both multilateral and bilateral discussions with the US Treasury, because they're keen to stress that once any multilateral solution to digital services is introduced, the UK digital service tax will be replaced by whatever multilateral OECD compliance system is developed. Okay, thanks, Alex.
Okay, thank you, Lawrence. A lot of very relevant material for a lot of our clients there, particularly in the tech sector, IP-rich companies performing sales into the UK or through the UK. Moving on to a slightly different topic now. Many Israeli companies offer their employees equity compensation in the form of stock options or similar, and this compensation can be offered to employees of UK subsidiaries also. Furthermore, it's not uncommon that UK companies engage with individuals under contract as opposed to as formal employees. And in our final session today, Rachel's going to provide an overview, some of the key areas to look at in relation to UK equity compensation, as well as looking at the new off-payroll working rules. Some of you may remember this as IR35 that could impose withholding tax obligations on the payor. Rachel's also going to provide a brief overview of some of the COVID-19 support measures offered by the UK government.
Thanks, Alex. Hi, everyone. So we'll start with the employer share schemes. As Alex said, very popular way to incentivize employees, particularly for businesses at a startup stage or development phase that don't have large cash reserves to attract high talent. So share incentives offers a good way to attract talent with the promise of a larger payout in the future and aligning those employees with the growth and success of the business. Broadly speaking, in the UK, when any employees, including statutory board directors, receive shares or securities, they fall under the employment-related securities regime. And this means that income tax, i.e. sort of employment income tax, which may attract payroll obligations, can arise on any transactions in those securities. So the acquisition or disposal of shares, for example, may attract income tax and payroll charges. I just wanted to walk through one of our more popular schemes here. So the UK government offers 4 tax advantage schemes specifically, which allows the risk of those income tax charges being reduced or changing some of those charges essentially into capital gains, so moving it from an income tax to a capital gains regime. EMI, enterprise management incentive options, are the most tax advantaged and very popular way to incentivize employees. These are typically used by smaller, fast growth companies. And what that does is allow you to shift the growth in value between the current share price and the future share price when the options are exercised into the capital gains tax regime. And if the employees held the options for at least 2 years, that actually reduces the CGT rate down from 20% to 10%. Now, if you think trying to pay the equivalent amount out in a bonus, for example, to an employee would attract payroll, income tax and NIC at rates of up to 47% with employer NIC costs as well. It's a hugely tax advantaged scheme. It does need to be granted over shares in smaller companies, so less than 250 employees and less than 30 million gross assets. And it does need to be in a non-subsidiary company. So, for example, if you were considering this as an Israeli parented company, it would need to be those company shares. Now, there's nothing in the EMI legislation that stops the grant of these options over overseas companies, but it just would require sort of specific looking at the UK legislation, making sure that all the criteria are met and the correct documentation is put in place. Alternatively, you may come across this if you're looking to acquire a UK sub, they may have EMI in place already, and just something to consider when that company is bought, that they will no longer meet that non-subsidiary requirement and the EMI options will need to be exercised or converted or will no longer qualify. Aside from the tax advantaged specific schemes, generally employee ownership can be pretty attractive. So either giving employees shares so they're then into a CGT regime and can benefit from CGT on the growth and the value of those shares rather than the payroll tax rates. It can be tricky to manage the risk on these plans. So as I said, any transactions in these shares for an employee or a director can bring income tax and payroll charges. So it's always worth, if you're looking to give shares to individuals or asking them to buy them even, to consider if they're a UK taxable individual, do they have any duties in the UK, do they sit on the UK board, for example, considering whether income tax might arise and seeking appropriate advice on that. There are also filing requirements each year for businesses that give their UK taxable employees any securities need to be reported to HMRC by 6th of July each year. And thinking about what's new or what might come in the future, I mean, these plans that we've touched on and these sort of arrangements and the legislation around it has been in place for a number of years now, a fairly well-trodden path, well established, and hasn't been any significant reform in recent years. There has been a call for evidence issued in the last couple of weeks by the government on EMI specifically. Potential reform might follow, with some calls, for example, to even expand the EMI scheme beyond the current requirements, which are quite restrictive in the type of companies that can implement them. So watch this space. EMI might yet be extended and offered to more companies. And similarly, in the past few months, we've had a government consultation on capital gains tax, with some commentary, I suppose, that there's a perception that they may seek to narrow the gap between capital gains tax and income tax, and there was speculation that that might even be brought forward in our budget last week, but no sight of that yet. So as it stands, CGT is a lot more favourable than an income tax regime at the moment. And if we change tack slightly and move on to off-payroll working, so I suppose if I just headline this even with a note in the landscape of things at the moment, I'm sure you'll all be aware of many companies globally attracting attention for operating on a non-employee basis. In the UK, we had a decision in our courts last week on Uber. Certain employees or workers, we should say, need to be careful of the terminology, had brought a case against Uber, which the UK government decided in the workers' favour that they should be considered not self-employed individuals, but workers for employment law purposes, which would give them rights to national minimum wage, to certain protections as workers, and to paid leave, for example, which Uber had previously denied on the basis that they were self-employed individuals. We can see there's a lot of, I suppose, complexity around substance over form. You know, you might have a contract that says you're a self-employed worker, but the courts clearly look to the substance of that engagement and considering factors such as who had the most control in that relationship, who had the bargaining power, was it the individual or the company that they worked for? Did they have an opportunity to be profitable? So in the case of the Uber drivers, the only way they could make more money was to work more hours. They couldn't work more efficiently because the algorithms were all set by Uber. This has been a very topical issue and one being looked at certainly by businesses as to their engagement models with individuals. One statutory change that is coming in from next month, however, is on off-payroll working specifically, where individuals engage via a personal service company. So if, for example, I provided my services through a company I'd set up myself, Rachel Chalmers Limited, and I provided my tax services through Rachel Chalmers Limited to a client, PUI, for example, I would fall under this legislation. I would need to consider whether, if it were not for the PSC, would I look like an employee? Have I just set up that PSC as an artificial arrangement? And actually what I'm doing is so similar to an employee, I should be treated as an employee for tax purposes. Most people set up these companies as a way to reduce their tax exposure. So by doing so, if I had my own company, a limited company, and I received fees, gross of income tax and NIC, no social security or pension costs, for example, on it, I could then extract that as I wish through dividends or making use of my personal allowances. HMRC have realised that there's a huge potential of loss. So at the moment, current non-compliance costs about 1.3 billion a year by tax year 2024. So they have taken action in legislation, which is effective next month from 6th of April, to ensure that where individuals engage through such an arrangement, it is the end user of their services that must consider whether they look like an employee, and if they do look like an employee, apply payroll tax and social security as if they were an employee. About 60,000 businesses are expected to be impacted from next month, with contractors taking less take-home pay home, and of course businesses bearing additional costs of employer social security and associated employer compliance costs.
So if we, I'm just going to jump in. So if we gave a simple example here, say one of our clients had a UK subsidiary, and the UK subsidiary received tax services from Rachel Chalmers Limited, our UK subsidiary could have an obligation to withhold payroll taxes, and that's a change that's coming in next month. And if it doesn't, then it's bearing that risk. Yeah.
Exactly, and not only a risk to withholding the actual taxes, but they must, under legislation, undertake a determination, so a status assessment, issue that company and that person with a statement saying we either think you are an employee for these purposes or we're not, and here's the criteria that we've used to assess that. And also establish a dispute resolution process. So if I say I disagree with your judgment on that, then you need to have a process in place to handle that and give me a response within 45 days. So it is something the businesses have been preparing for, hopefully for a while. This was delayed, it was due to come in last year and delayed due to COVID. If we think of another scenario, so if in your example, Alex, instead of engaging with the UK subsidiary, I engage directly with an Israeli parent, for example, the situation's a little less straightforward. So I'm a UK taxable individual working in the UK, so I may fall under these rules. We would look to whether the Israeli company I'm engaging with has a presence in the UK. So, for example, a PE, or is otherwise considered resident in the UK. And would maybe even need to consider, my services make you have a PE in the UK in that case? So it can be quite complex. So I guess the key thing is if you have UK workers, whether they're employees or not, you could have obligations on payroll.
So I suppose what we might see is that whereas there's some discussion about whether to engage a person as an employee or as a contractor, as a UK company, we may wish to insist that they have a contract of employment, and not be willing to engage with them as a contractor.
Yes, I think engaging with them as an employee would really clarify the situation. But then, of course, engaging as an employee brings all sorts of employment law implications to that as well. You're then entitled to statutory benefits such as sick pay, maternity, and paternity cover, annual leave, that sort of thing. So it is one that employers have to weigh up. And we're still seeing a lot of businesses that really value that flexibility of having a non-employee workforce and being able to employ people for short-term contracts. And I suppose the important thing is to note is you can still engage people in this way as long as they don't look like an employee. So the tests they look at, maybe are what the type of services they're providing, who has the control over them, is it personal service, sort of labour you're providing, or a specialised service in quite a discrete project. There's a lot of factors to be considered. So I would definitely recommend seeking advice on that if it's one that impacts your business. And I think just to touch on our final slide on COVID, couldn't do a session without mentioning COVID and the government response to that. Most notably, the UK government introduced a furlough scheme, which allowed employers to essentially stand down employees that weren't or couldn't work because of COVID. And the government would give grants of, at the height of it, up to 80% of wages for furloughed employees, plus employer costs, including pension and NIC. So employers could really keep employees on their books without working and recover most of their costs from the government. That's been tapered down over time, and is in a more flexible furlough scheme right now. So you can furlough people on and off for periods of time, depending on when they're working, and still claim up to 80% of their wages from the government. And that's now been extended through to September. So really quite a supportive measure from the government, but very costly. I think we're about £50 billion worth of claims from the government under this, from 1.2 million employers. Some estimates late last year suggested that the scheme had overpaid, i.e. fraudulent or incorrect claims, by at least 3.5 billion. A huge amount that the government is now looking to recover. So they've set up hotlines that essentially employees can whistleblow if they think their employer has been claiming these grants incorrectly, or it hasn't made its way to the employee, for example. The whole purpose of this is to pay employees for the time that they aren't working because they're on furlough. And recently the government is now publishing lists of those businesses that are claiming grants, that allows greater transparency and more challenge around that. Whilst there's no requirement to do so, some high-profile businesses in the recent months have opted to pay back the furlough, saying, for example, in the construction industry, have said that they managed to actually continue operating quite well, posting significant profits, and felt it wasn't appropriate to be taking public money to prop up their business in that time. So like I say, there's no requirement, but a bit of peer pressure and media spin, as it were, I suppose, for businesses wanting to look good by returning those funds. but we can definitely expect to see increased HMRC compliance in this area as they seek to recover the costs of that scheme, which has been very expensive for the government.
Thank you, Rachel, for all of that. Just take that HMRC discussion, COVID, and to wrap up, I think I just asked Lawrence maybe to give us some commentary and to give the audience a bit of a flavour of what a standard HMRC inquiry looks like. A lot of the audience will be very familiar with the Israeli tax authorities' attitude to foreign multinationals who have R&D in Israel or who do sales through Israel, and they're very sort of heavy-handed and aggressive approach. So, Lawrence, just provide us a bit of a flavour of what a standard HMRC audit looks like, and whether we're expecting a more aggressive approach. Have HMRC increased their capacity to raise funds, to issue audits in order to fill the budget gap due to COVID-19? I think that would be a very interesting way to end this session.
Yeah, thanks, Alex. Yeah, I think you raised some interesting points there. I wouldn't necessarily characterize the way that the UK approaches these things as aggressive so much as principled and detailed. The UK prides itself on its what it would regard as its sort of ethical standards, and would always seek to operate very strictly within the law. So any discussion, including any ultimate settlement with the taxpayer, would need to be grounded in what we would consider to be a principled-based settlement. The days of simply being able to do handshake agreements to make things go away, I think, have receded into the far distant past now. I think a couple of things to know, based on what you've said, Alex. The first is that the increased resource is almost exclusively around transfer pricing competency, and people who properly understand supply chains, particularly with multinational enterprises. So the kind of PE risk that we were talking about earlier, diverted profits tax, transfer pricing, is really the area that is receiving most focus of HMRC inquiry. The style is generally, I would say, to keep it as collaborative and cooperative as possible. Indeed, a specific compliance facility has been introduced where companies can almost choose to preempt an inquiry by putting a detailed report together and submitting it to HMRC as a basis for discussion and negotiation. That file needs to be reviewed by an external service provider. But if it's signed off by both the company and that service provider as being factually correct, then it can be taken as a basis for discussion and won't necessarily be tested in a way that most assertions would be. What I think we have seen is a shift again, and sorry for repeating myself on the BEPS project, is a shift to scrutiny of people functions. And that would include, very typically in a transfer pricing inquiry, a desire to carry out functional interviews with key people, particularly on the sales side, if we're talking about PE and diverted profits tax, and also on the research and development side of things. It's not uncommon for chief technology officers and research and development specialists to be interviewed by HMRC to find out exactly what they're doing, who they're reporting to, and what kind of projects and outcomes they're working on. The other thing we've seen, which I think is in common with a lot of tax authorities, and probably is a precursor to the Making Tax Digital project that Irina was talking about is a shift to requesting more contemporaneous evidence. And that would include not just a formal analysis of tax positions taken in the tax returns, memos, opinions, etc., but actually contemporaneous, emails, notes of meetings that have taken place, the evolution of ideas, not just the documentation of the final idea. And I think some taxpayers have been surprised by the breadth of requests that have been made, for the provision of emails, say, leading to a particular transaction. Again, I think the important thing there is to consult with advisors, because very often issues of privilege, issues of precedent where we can limit the amount of work that needs to be done, and just concentrating the revenue's minds on the issues that really matter can significantly reduce the scope of information requests.
Okay, thanks, Lawrence. That's really interesting, and I think everyone will benefit from that insight. I think that's a very fitting way to wrap up this session. So thanks once again to today's presenters for taking the time to share their thoughts on the latest UK tax developments. We hope the session's given the audience a better awareness of the issues, and we thank everybody for listening today. Thank you. Goodbye.
Thank you.